All right, morning everyone. Get started. All right, Friday session was I saw a nice little sell-off there in the States. Maybe a little bit more muted than what we thought it could have been at the beginning. We were down, once again down 16, 17, 18 points on S&P futures, even pre-market, and we weren't able to get follow through to the downside again. I mean, we kind of hung down there. Obviously, you can see we bounced around a little, finished, within a few points of the lows in the S&P. But normally, in the past when we've seen those sorts of moves early in the pre-market, anytime you're kind of 10, 12 points or more pre-market, I would say historically, and that's either way, up or down, historically probably 80, 85% of those moves follow through further in that direction. We haven't seen any follow through to the downside on those, early pre-market S&P down days. This has been, I don't know, maybe the sixth or seventh time we've seen it in the last 3 or 4 weeks, and sometimes we've seen us really drift up significantly higher. This case, we only bounced up a little bit, but we didn't see a continued move in that same direction. We continue, this is going to be one of those situations possibly where the market lulls everyone to sleep, makes everyone very complacent when the market shows its hand early like that, and maybe eventually we do get a proper breakdown that no one believes, and everyone continues to try to pick the bottom because the bounce is always coming. We continue to look at the data set that's coming through markets at the moment. We continue to see the rig count in the States falling. We had Michigan consumer sentiment on Friday, which was much better than expectations. Producer prices rising, biggest increase since 2012. So we're starting to see a little bit of inflation come through. The data sets turn back better again. You're seeing things like rail traffic numbers really taking off again. So it looks like second quarter GDP is probably going to be really solid. We've seen consumer sentiment bouncing. We're seeing wage growth. We're seeing rise in inflation now starting to come through, and I think when we start to hit the year-on-year cycle in oil from when oil fell, if I'm not mistaken, it was kind of December last year when we traded down to about $70 in oil. Once we get to that point year-on-year, I think you'll really start to see inflation at a much higher level, because remember, we're pricing in deflation in one of the most major parts of the CPI basket. So all in all, I think the data sets really turn back better. I think the Fed's going to be under more and more pressure to raise, especially if the dollar doesn't strengthen too much more in the near term. We've seen rates which have really given us an extended rally here. We backed off the tops a little bit from about 248 in the 10-year down to about 233 today. But if we, like I said, I think the writing's on the wall. It's just a matter of time as to when. The market's got us priced into less than 6 months for the first time in ages in terms of a rate hike. We may see that continue to get shorter, and I think as that does get shorter, I think the market gets a little bit more nervous of what's to come after that. All right, looking at Asia overnight, definitely under quite a bit of pressure. At one point, I think the Chinese markets are down even more than that. We'll have to see if we can get any follow through in our market on the back of that Friday. We opened up down a few hundred points open early, and then we just drifted higher from there. Right now we're below 46,000 strike level with closeout being 2 days away. So it could get interesting if the market can stabilize at this level and even push a little bit lower. But there's not a same sort of thing. There's not a lot of news out of Asia this morning. Just under pressure there a little bit. Maybe a little bit of flows, coming out of some of these emerging markets going into Saudi Arabia with those markets available to foreigners now. So that could be a little bit of a detraction from the emerging market space. All right, this morning chart of interest. We're going to look at. We talked about the stocks being a little bit historically expensive, and they are. But what I think is really important here is that usually at the end of these bull cycles, you can see here over the last 3 cycles in particular, we've gotten a hell of a lot more expensive than this. Maybe the economy was pumping a little bit more at the time, but we are not nearly as expensive historically, in terms of toward the end of bull market cycles. It gets a hell of a lot more expensive traditionally. And so we've got to watch out. We've got to be careful, looking at things, looking at averages, of 5 years and 10 years in terms of price to earnings ratio, and trying to look at it and saying, oh, we're expensive, now we're going to correct. Because, historically we don't correct at this point in the cycle. Historically we correct, with another 20% upside in the or another 20% to go in the business cycle before we start to correct in higher PEs. All right, corporate action, stocks going ex-div. No, sorry, these stocks all went ex-div on Friday, right? Yeah, these stocks all went ex-div on Friday. Sorry, just ignore all that. Looking at market data today, we've got Empire Manufacturing in the States at 2:30. We've got industrial production at 3:30. Not a whole lot else to look at. All right, let's get into the maps. We'll have a really long list again. Kind of just feel like we're in wait and see mode. A lot of charts kind of in no man's land at the moment. We're going to look at a couple that I think are important. Tencent being one of those. We've been waiting forever. I think the stock has put the entire market to sleep. We saw a correction, out of our local market to an extent. I think we were down. I'm not 100% sure what, maybe 6-7% off the top in our local market. This thing, over the past couple months when our correction came, has just held really solid. We've been in this tight little range from about 1860 down to maybe 1780, 1775. And we broke out of that on Friday. We closed up around 1865, even traded a little bit higher. And I really think that the overall pattern is more of a descending triangle, which we've obviously broken out of now as well. So things definitely looking solid for Naspers here technically. So just keep that in mind. I think that maybe we've the rumps thinned back out a little bit. We're definitely not trading at such a discount to the rump anymore, but just this stock technically is looking like it's maybe broken out here. All right, Harmony. We look at Harmony here. One of the things that I'd like to point out here, and I always like it when stocks behave like this, because it just gives me more confidence to play it. You can see here, so we broke below multi-year lows. I mean, we go out to a 5-year chart and it won't be anywhere. So, I mean, you can really see this is multi-year lows, right? And we've broken out, broken below multi-year lows here in this 1, 2, 3, 4, 5, 6, 7 sessions in a row. We've actually consolidated just under the breakdown point here. So to me, this is broken. This is broken down. This is bearish. What's happening right here? This is consolidation under what should have been major support. And as soon as we break out of this little consolidation, which I'd throw out, maybe call it 1630, then I think you can really see us have a real move to the downside. I was a little bit nervous on potential shorts like this the other day after AngloGold was able to sell one of their mines and get some cash. And I think that's the real worry with the companies like this that are out there. It's a horrible environment to probably be trying to sell assets, though. So I don't know how many more people are going to really be able to move assets, but let's keep that in mind, that is a risk, but technically it's looking very bearish here out of Harmony. All right, next one we'll look at is Sanlam, and we'll look at Sanlam on a 30-minute. We'll zoom it in here a little bit. We've been putting in a real consolidation for about 2 weeks between, call it, 69.10, 69.20, somewhere in there, and 67. So it's been a little bit lower than 67, yes, but it hasn't really broken down below 67. I think 66.80. Let's peg the level at 66.80. Let me draw it a little bit lower. But bottom line, you see what I'm talking about here. We put in a real consolidation here in a tight range. I mean, it's only 2 rand. That's a 3% range. We were bouncing in there for 3 weeks, and we've had a lot of volatility in the last 3 weeks. So the fact that it's staying in here is making this level more significant. If we break below this level, obviously we're going to be looking for a move down about $2. If we can get above it, then maybe we come in and we can test resistance, which, if I'm not mistaken, maybe up here closer to 70, 71, 70, 72. All right. Next one we'll look at here is Foschini Group. Foschini basically bouncing up and testing resistance here, call it somewhere between 60 and 61. You can see here we had a nice little reversal off of support, beautiful reversal off of support, down here around 146, 147, where we're talking about around the 200-day moving average. Also coming up now, failing at 61, 62, somewhere in there, and reversing down. I think another test of this level at 46 or 47 could be good, and probably be a decent little place to nibble as well if it does get down there again. And the last one we're going to look at this morning is ARI. So this thing has really been a dog as well as most of the others in the sector, but you can see here we've got a lot of touches on this line, so this becomes more and more important. I think if we drop 92, then I think you're going to get some confidence to really sell this thing, and quite a big target actually to downside, probably at least down to around $70, maybe a little bit lower if we drop the support here in ARI. And that's it for today, guys. Good luck out there.
Oh boy.